All right, welcome everyone to tonight's macro madness. Oh no, this is the Sunday macro wrap up for Sunday, October. And so, apologize for people on the stream. I had to unmute myself. But so as we're in this, good news equals bad news environment, if we start to shift into a situation where inflation is starting to cool while we have, stable growth or at least, inching higher, that's actually what's known as Goldilocks. And if that happens, then, we'll get the soft landing that the market expects. And so, we've been seeing some recent leading indicators that are suggesting that inflation is going to start to cool in the last 2 months of the year and then heading into 2026. And so, the market could tread higher during this period, but if it goes too far where disinflation turns into deflation, and then we have growth continuing to slow or even go down from there, that could be more of a recessionary risk, which the markets would actually reverse on that type of market indicators that we'll get there. But as of right now, it's continuing the good news equals bad news as well as this Goldilocks. And so I really don't see something, even as a government shutdown, that's going to stop this rising market here. And so we'll go ahead and take a look at some of the things that happened last week as well as what's coming up this week. Because of this government shutdown, we are not going to have key data this week that we would normally get, which is normally here. Let me take a look at the calendar. So normally we would get average hourly earnings as well as non-farm payrolls. We'll see if we'll get that. We were actually supposed to get it last week, but there was no jobs numbers. And so typically a government shutdown lasts, anywhere between a week or 10 days. And so we'll see if that happens. But yeah, until then, we won't get any type of government released data. And so it looks like the market really likes that, though. We did get private data, though. And so the ISM services PMI came out showing that activity was remaining stagnant. And so this was probably the biggest data from last week, the most important one, because services, as we know, makes up nearly 70% of American consumption. It's not a goods economy. This is a services-based economy. And as you can see, it remains relatively low at levels similar to what it was back in July as well as May. And so, with services continuing to cool off, there's still a risk of going into that more recessionary type of environment. But, right now, even if you have ISM services start to pick up, that would be more of a Goldilocks type of scenario and confirm what the market is currently trying to price in. The employment perspective of the services ISM, that still remained low. So employment or struggling employment in the services sector is still a problem. New orders came back down after a large August acceleration. That was mainly a lot of these different businesses getting ahead of the holiday season. So that actually came back to normalizing, while prices still remain high, right? And so with new orders remaining low and prices remaining high, there's still potential risks heading into 2026. And so, really, we don't know when those risks might materialize and when and what magnitude. And so, us as investors, it really doesn't matter like trying to predict when these events will happen. But what we have to do is just play the cards that we're dealt right now, which, the market is still signaling a bullish trend, and it doesn't look like anything is going to disrupt that. And so pretty much every single day last week, we were seeing new all-time highs for the S&P 500. And yeah, unless we have some type of crazy news event or anything like that, my team and I don't see this trend, breaking right now. And so anytime there is a dip, that does come down to the low end of the trading range in our trading range model here. Those are all times to buy, right? So it's just dip buying mode, as well as any other assets that are positively correlated to the S&P 500, positively correlated that are also at the low end of the trading range. Those would also be dip buying moments. Now, it's interesting seeing gold having a bit of a correction here. And remember that gold is a rate sensitive asset, meaning that if interest rates, like the 10-year US government bond yield, rises and falls, that's typically a mover of gold. And so, as we saw pretty much over the past couple months here, we've only had a couple red days for gold, and yeah, it's been in a really fast acceleration and hasn't really been giving too many buying opportunities. And so, anytime it goes red, we're pretty much buying. And so, when taking a look at the U.S. government bond yield, you can see that it's had a little bit of a rebound, and it's also come down from here, which gold has liked. If, however, we do start to see the 10-year bond yield break higher above this 4.2% mark, then that could actually put more headwinds on gold as well as other precious metals there. So keep an eye on that, as well as the DXY. Both the dollar as well as bond yields are in a positive correlation. And if we see those continue to accelerate, that would probably disrupt the current trend, or at least give a good buying opportunity for the S&P 500 and other positively correlated assets there. When taking a look at the best performing sectors last week, what's interesting is that healthcare had a huge pop. So an over 6% acceleration. That's really unusual considering that healthcare XLV has been in a bearish trend for pretty much the majority of 2025. And so let me go ahead and pull that up here. Yeah, so this had a very large acceleration, and as you can see, if I scroll out here, it's been in a bearish trend almost a year actually. And so this breaking trend here from bearish to bullish is a pretty big, change, especially with this being more of a defensive type of, sector ETF. That is a big signal there that I'm keeping an eye on. So yeah, we had healthcare be one of the largest performers, as well as utilities and tech. Utilities as well is another defensive sector, and so you could see a lot of people taking profits at this time and shifting into some more defensives, but still, even with this large acceleration in healthcare, you still have a lot of other assets that are in, or sectors that are in a way much more stronger bullish trend, such as consumer discretionary, communications, as well as financials, energy, and tech, right? So interesting stuff there. Now, heading into this next week, we are going to have a speech from Jerome Powell on, when is that? I believe it's on Thursday. Okay, so yeah, on Thursday, October 9th at 8:30 a.m., Jerome Powell is set to speak at some type of board. So we should go live for that as well on that day. But it'll be interesting to see what his thoughts are on, inflation, because the last time he spoke right after the September Fed meeting, he went and spoke at another public event where he talked about, his concern about inflation, and it caused a little bit of a sell-off that day, which was another buying opportunity. So we'll see here if that tone shifts from focusing on inflation to more so focusing on, growth, or even just, continuing their rate cutting regime that they're currently in. But there's not much private data that is coming out. And again, with this government shutdown, we're really not going to have any other new data come out. And so that could be a double-edged sword. We'll see what happens this week. But again, if we get any type of dips in the market, we're just going to buy those as a team. Going back to the inflation front, taking a look at the Cleveland Fed's inflation nowcast, for the month of October, and that gets reported in the second week of November, that's actually having a deceleration from 3.0% for inflation across the board down 10 basis points, which is in line with our team's expectations that inflation will start to slow a little bit more in the last couple months of the year heading into 2026. Which again, that it's all the big thing here is what is growth going to do? And that's why we have to pay attention to the 10-year US government bond yield because it is the bond market trying to price in future growth and inflation expectations, right? And I've said it in previous live streams that if I was to just look at one chart for the rest of the year, it would be the 10-year bond yield right here. And so, yeah, as we can see, it's in a bearish trend currently, which means that bond prices and bond price ETFs like IEF are in a bullish trend, right? Because bonds and yields are oppositely correlated. And so, as yields in the 10-year start to spike here, you could have another opportunity to buy some more, 7 to 10-year treasury bonds on a dip. And it is a good time right now to have gold, bonds, as well as some equities because all of them are currently in a bullish trend and all of which are pretty good diversifiers in the portfolio. So it's very rare that you get all those bullish at the same time. So you definitely want to take advantage of that. But yeah, typically the way that these Sunday macro wrap-ups work for those who are new on the stream here, typically the first 20 to 30 minutes is live streamed and the last 30 to 45 minutes is only for our Macro Optics members and they're currently on a Zoom call. But at the 20-minute mark, we'll just cut it off and we'll go into questions. Yeah, the yield curve is still remaining steep. We can look at this, looking at the yield curve compared to 1 year ago. You can see that this steepening effect has happened by the short end of the curve falling while the long end of the curve is rising. And so a steepening like this is what's called a bull steepening, and that's typically when you start to have stronger inflation or growth expectations while also expecting that the Fed is going to cut rates, right? And that's part of the reason why we've had a large acceleration is because the market is looking at what the bond market is saying, and it's saying that a soft landing is becoming more and more probable. Now, you always have to remember in the back of your mind that all hard landings start as soft landings, right? And that goes all the way back into what we were talking about before with paying attention to the context in which the inflation starts to come down even more, right? And so we have to pay attention to growth, and you want to make sure that you're paying attention to what the 10-year US government bond yield does. Other than that, this week that I can see here, we got consumer credit report on Tuesday. All the public data is halted because of the government shutdown, and that could be pushed to Friday, so we'll see. But yeah, the big thing is just the Fed or Jerome Powell speaking on Thursday, October 9th. Other than that, I mean, if we get an opportunity to buy dips this week, our team is going to buy. It's not financial advice, but that's what we are thinking here. All right, let me just see. I did write a little bit of notes here. So yeah, S&P 500 new all-time highs, Dow all up 100 basis points, NASDAQ new record highs. It's interesting that strength right now is still centered firmly in large cap tech. And then you're also seeing a little bit of a move into defensives like we talked about. Because of the government shutdown, you start to have a little bit of a correction in things like defense and aerospace. The aerospace sector or industry has been in a bullish trend. And so, that could be another dip buying opportunity as well. Let me go to here. So ITA is the preferred ETF that my team and I like. And so, that continues in a bullish trend here. But, the government shutdown could affect some of these. So, yeah, maintaining a bullish bias, favoring quality over cyclicals. 10-year up, the 10-year bond yield is up 4%, or up to 4%. 2-year is up to 3.56%. add duration on high grade corporates, so 5 to 10 year, like we just talked about. Bitcoin had a pretty large acceleration here over the weekend to close to new all-time highs. Let's see here. 123. Yeah, I mean, actually, if it closes here, well, it did close. Okay, so it closed at 8 p.m. And yeah, actually, Bitcoin, welcome to new Bitcoin all-time highs. And this is a pretty interesting setup here because Bitcoin did have a decent drop off. We had it neutral in our model pretty much from September 10th till September 24th. It went bearish for like 2 or 3 days, and then it went back to bullish here in our model, and then now it's up. So this crazy whipsaw that we just saw in Bitcoin, this is a very good sign. And so I think for gold as well, because people are ditching TradFi and going more into alternatives like cryptocurrencies. And so Bitcoin is obviously signaling that this government shutdown is benefiting it. So yeah, and as well, Bitcoin is a highly positively correlated asset to liquidity, um, central bank liquidity, as well as growth and inflation. And so this could be also Bitcoin pricing in a soft landing as well. But my team and I, whenever Bitcoin does something like this, even though you might have missed this move here, don't try and chase this. You want to make sure that this settles down and then starts to consolidate to the low end of the trading range before buying it again. So it is a decent sign though that we can start to add that back to the list in order to buy dips in Bitcoin. Same thing, Ethereum back to bullish trend, and then Solana as well as AVAX have remained in bullish trend. So we see those here. Solana and AVAX. So that takes care of crypto. We already talked about gold. Yeah, gold, silver, copper, all doing incredibly well. Let's take a look at the silver to gold ratio. Silver has maintained a bullish trend compared to gold. So, we still hold both, but obviously you can see here that silver is beating gold in terms on a trending basis right now. So silver is doing very well. Copper is also back to bullish trend after that crazy drop off from the tariff tantrum. Let's see. And then also as well, all of the different miners have been also doing well. So copper miners, silver miners, gold miners, all of those companies have been doing pretty well in this type of environment. Let's see. In terms of Forex, Euro continues to do well. You can get exposure with FXE, but obviously from the other things that we've been looking at, there's way better trends to own. So let's see here. New York Fed inflation survey is on Monday, and that's pretty much it, as well as the Powell speech. So yeah, bottom line, before we close off the stream and head only to our members, bottom line, the markets are embracing this Goldilocks narrative, moderate growth to stagnant growth with cooling inflation as the Fed starts to continue their rate cutting regime. So yeah, it's good to stay in the markets, in the equity markets on some of these risk-on assets, but we have the benefit of diversifying with a bullish treasury market as well as a bullish gold market. So you have all three of those things working for you at the same time. So it's pretty good to be invested right now. And then lastly, before we close off the stream, the target rate probabilities for the October Fed meeting on October 29th. There's currently a 94.6% chance that they're going to cut by 25 basis points, which really has not changed. And then if we take a look at the January meeting, so this is 2 months out. Currently, they have it at a 53% chance that will be 50 basis points lower. So it's betting that it's going to cut 3 times in a row. And then let's just take a look at March. Okay, so maintaining, cutting by at least another 75 basis points from here by March. So yeah, And then let's see, just out of curiosity, let's see what it's currently pricing in an entire year from now. Okay, so an entire 100 basis points lower from now until next year. So that's a pretty decent dent in lowering rates, and we'll see what happens from here. We are definitely in rate cutting season, and we'll see what happens. But with that, we will go ahead and close it off to the public stream, and we'll go into the members who are on the Zoom call here. We appreciate everyone for joining. Have a great rest of your week, and we will see you next week. Bye, everyone.